Focus now on the Adani portfolio. It has been in a swirl of news due to various action coming in from the Department of Justice and the SEC in the US. But Agam joining us now with a deep dive on the Adani portfolio, especially on credit risks, Agam.
Right. Well, from the latest that we have in investor presentation, we're actually looking at the risk evaluation of the entire group as a whole, taken as a portfolio. And I'm going to start off with the equity deployed as assets. This number stands at around 60%, and while a number of 50% would have been good, 60% is even better. But what does it mean? It only means that this means, well, higher stability, because the higher amount of equity that you have as a percentage of assets, the better it is and the more stability that your portfolio has. Let's move on and talk about the next factor here. And this is to do with, well, the distribution of sources of funds. Now, according to the group, it is well distributed, and this once again means more stability, because naturally this will also perhaps indicate that you have more sources of funds in order to, well, put and propel your business forward. And given the fact that the group is well diversified across energy infra, well, this always bodes well. The next point perhaps is the most important one, and this is where we're talking about your EBITDA with respect to the total contracts as compared to the contracts. So pardon me, when your earnings from contracts is about 70% of your overall earnings. And by that I mean, this is given the fact that your earnings and from your contracts are over many years, it gives you that much more visibility, and that much more visibility also gives you that much more stability with respect to earnings going forward. And that's what you have in terms of your contracted earnings. And moving on, we also have your borrowing number. Portfolio borrowings is less than 2.5 times your EBITDA. Do remember, this number has already come off from well over the mark of 3, and the chairman of the group has also indicated that this number will likely go to 2.2 times. And the reason why this is important is just indicates the ability of the group to service your debt. And the final point coming down to that, well, what we're keeping an eye on is your cash reserves with respect to borrowings. That stands at around 20%. This obviously also means that the higher amount of cash you have, it lowers your debt. So this once again does bode well for the longevity of the company as well as its ability to service debt. All in all, a lot of these factors coming together and indicating that the group is on a strong footing, and there isn't much to worry about, at least when it comes to risks associated with debt, earnings and cash flows.